Right, today I want to share about this particular news over here, the S&P 500 uh, earnings update. Okay, so we have a strong quarter 1, but caution ahead as tariff looms. Okay, we know that tariff is the word in the market at the current moment. Like it or not, we have to live with it. It's expected during a Trump reign, right? Now, earnings have surprised to the upside this quarter, but warning signs are emerging. Now, as the Q1 2025 earnings season progresses, the S&P 500 has delivered robust results so far, with about 72% of companies having reported, 76% beat EPS, earning per share estimates, and the blended earnings growth stands at an impressive 12.8% year over year. Now, this marks the second straight quarter of double-digit earnings growth and the 7th consecutive quarter of overall growth. Now, while this is encouraging, a closer look suggests a more cautious outlook going forward. Okay. So far, like I said, Q1 has been solid, but there are some weak spots in Q1. Now, revenue growth came in at 4.8%, extending the streak to 18 consecutive quarters of rising revenues, though this is below the 5-year average of 7%. Now, the net profit margin improved to 12.7%, up from 11.8% a year ago, driven largely by standout performances from sectors like communication services and healthcare. Now, key drivers included big surprises from companies like Meta, Alphabet, Microsoft, and Bristol Myers Squibb. Now, I've featured the Alphabet and Microsoft in our reports, our weekly report. So if you have bought it, especially Microsoft, you would have seen some pretty nice profits right now, especially it came up with better than expected earnings, which saw a gap in its prices. Okay. So, however, not every sector shared the optimism. Energy and industrials lagged, with energy earnings falling negative 14.4% year over year, dragged by lower oil prices. Okay, so for Q2 and beyond, analyst downgrade signals growing caution. Now, despite the positive momentum, analysts have trimmed Q2 earnings estimates by negative 2.4% since March 31st, a steeper cut than the average for the past 5 years at negative 1.8% and 10 years negative 1.6% averages. This is a clear sign of caution. Other than that, tariff worries are impacting future projections. Companies and analysts are factoring in potential margin pressures and demand risks. Sectors like energy and materials saw a drop in their values, where that's a negative 14.8% drop for energy and 11.9% drop in materials, because they both saw the sharpest downgrades. Now, industrials also reported revenue contraction as well. Okay. Now, only utilities and communication services saw improvements, with utilities adding 0.8% and services up by 1.4%, bucked the trend with higher estimates. Looking forward, analysts expect Q2 2025 earnings per share growth of 5.7%, Q3 earnings per share growth of 7.8%, and Q4 earnings per share growth of 7.1%. So for the calendar year 2025, overall earnings per share growth of 9.5%. This forecast reflects optimism, but also lower momentum compared to Q1's 12.8% growth. Okay. So given this risk, the energy sector, already suffering from lower oil prices, could face further pain, while manufacturers and discretionary consumer firms could see pressure on both revenues and margins. So what are the market valuations and expectations? Despite near-term risk, the S&P 500 trades at a forward PE ratio of 20.2, above both its 5-year at 19.9 and 10-year 18.3 averages. Now, this suggests investors are still expecting earnings growth to hold up through 2025 and into 2026, where analysts forecast 11.1% earnings per share growth. Now, analyst sentiment is mixed. 56% of ratings are buy, with bullishness highest in energy, despite near-term struggles, communication services, and IT. Price targets imply a 17% upside from current levels, signaling optimism, but also reflecting dependence on solid earnings delivery. So the bottom line is this: Q1 earnings were strong and many sectors showed resilience. However, cracks are appearing. Analysts are growing cautious, trimming Q2 and full year estimates more aggressive than usual, especially in tariff-sensitive sectors. So with tariffs on the table and global risk mounting, the path forward may be bumpier, but investors should expect moderate earnings growth going forward. But any escalation in trade tensions could pose a meaningful risk to profit margins and market valuations. So in short, the earnings story so far is solid, but the next chapter may be more challenging. But this can change if in the next, 80, 70 days, we hear success in the negotiations, especially with the major economies. Okay, so something like with India, with Europe, and especially with China. Now, if we have these three negotiations progressing smoothly, then you could actually see a better development, a more positive development in S&P 500. Okay, but nevertheless, I think it's proven prudent to actually monitor the earnings on a quarter-to-quarter basis, because that is the best indication of how companies are handling the tariffs. Okay, with that, that's a report for today.